What is a fair value gap, and is it something that you can use in your trading? I've been trading for a long time, over 30 years, and I don't use fair value gaps in my trading, but it is something that you need to know about. I sometimes look at it and I sometimes see it. I believe it's very much an ICT concept. As we trade with support and resistance, and as we use trend support and trend resistance, and we use normal support, normal resistance, as we trade with price action, it's a good idea to understand what a fair value gap is, because there is a difference between a normal gap down and fair value gaps. There's two totally different things here. They're not the same. Since we're here, let's talk about the fair value gaps. And let me have a bit of coffee while we start. It is Coffee with Rob after all, so we might as well have a wee sip of coffee and then we can get started. Let's go and have a look at the charts. I'm going to show you the fair value gap. Then, after the charts, I'm going to show you the strategy that's going to make you money in the markets. Because as I've always told you, how many times have I told you guys this? The markets are 50-50. And a win rate doesn't make you money, and the squiggly lines don't make you money. What do the squiggly lines do? The squiggly lines give us a high probability trade. So I'm going to go and show you how to use the fair value gap now, and then we'll talk about the strategy after the charts. Here we go. Let's talk about gaps and fair value gaps in the markets. Let's get to the bottom of this. Guys, these charts I get from Funded Trader Markets. We've got an account together we use on our live shows. For all the guys that join us on the live on Tuesdays, on Thursdays, you get to choose trades on this account, and we choose the trades together and we have a little bit of fun. So this account is dedicated to that, and I use this to show you guys how to trade. If you want one of these Funded Trader Markets accounts, if you want to be a funded trader, there is a link in the description below. There's also a free Forex book for you down there if you really want it. And if you want Trade of the Day every day, do yourself a favor and join as a member. Right, so let's get on with it. Let's get on with what is a fair value gap. I've taken this chart out because there is a fair value gap here. And a fair value gap is pretty much an imbalance in the market, an imbalance in the levels. What it normally entails is where you get a tail on a candle that ends over here, and then you get a candle in between, and then the next candle starts all the way at the top here and leaves a gap. That is a fair value gap. So let me draw that in so you can understand how to draw it in for yourself, right? So there's your gap. Now you've got a gap that you can possibly use for your fair value trade. Now, how do you work with a fair value gap? Well, it's not insanely difficult. It's not out of the realms of possibility, or, so many of these systems out there become incredibly complicated, too difficult to use, and everybody just doesn't know what to do with them. But what you do is you simply wait for the price to come back into this level. It's a bit like supply and demand. Think of it like a demand level. It'll come back into this level, and there should be, because it's an imbalance, there should be some money orders left over in this area that you can take and go long again. Now, I don't trade with this. This is not something that I use. This is something that I believe ICT Concepts came up with, something to that effect. I've always traded price action, support and resistance. The Wyckoff system gives you a good idea of what that's all about. But these fair value gaps are something that has become popular in the market. So I just want you to know what a fair value gap is. But does it always work? Will a fair value gap always work? No. There's an obvious situation. Look, here's a fair value gap that would have come across here. Price just ran straight through it. Here's a fair value gap. Will price sit here and go back up? Maybe, maybe not. But in many cases, you'll find fair value gaps, and you'll see clearly that the price has simply run straight through it. Bullish fair value gaps, bearish fair value gaps. They're all over the place. If you look, here's another example of a bullish fair value gap. There you go. There's the gap. Runs right across here. What this does is it sort of runs through it and comes back out and goes up. Not very, very clear. So what I do with fair value gaps is I look at them in the market and I say, there's a gap. It might be something, it might not. And I use it in context with my trading. So I have my resistance, I have my trend resistance, my trend support. I have my support levels. There is a support level here, and I'll see if there's any confluence in it. I'll draw a trend in to see if it's breaking trend, and just like supply and demand, I'll just have a look and see if that fair value gap has got anything to do with the rest of the market. Now, there's a big difference between a gap and a fair value gap. You see, that's a gap. Now, a gap is normally something where the price closed and then opened maybe on a Monday morning after closing on Friday or the day after, and gaps will always be filled. Now, you may have heard this in the market before where traders say a gap will always be filled. But understand the concept of a gap will always be filled, because a lot of people say, but that's BS, the gap doesn't always get filled. It does. It really does. But what people don't understand is it doesn't get filled in the next 5 minutes. It doesn't get filled sometimes in the next day. It could take a year for the gap to fill. That's the problem. People think it's going to fill immediately. There's no immediate fill. Sometimes there is, like in this case on the US 500, there was a support, it bounced off and it filled that gap immediately. That's great if it does that. Then you know the gap is filled. It doesn't need to be filled anytime in the future. But if the gap is not filled, you can know that at some time in the future, if there's a gap there, that gap will eventually get filled. Why? There's no real reason for it. It's probably psychological somewhere down the line, but usually gaps are on the upside and usually the price reaches it and fills it anyway. It's a very subjective statement because there's no real time frame to when the gap gets filled, and there's no real way to trade a gap like that. So these gaps, all they are is a sign in the market, oh, I know there's a gap there. It'll most likely get filled sometime in the future. But what you're looking for is most likely rather a fair value gap. For example, on the US 500, there's a fair value gap. Now, are you going to trade that fair value gap? Are you going to use it? It hasn't filled. Prices come back up here. It hasn't reached it. And if it reaches it, it might reach it and send it on its way down again, carry on down. But that's a fair value gap that hasn't been filled. You see there's a gap between that and then a candle and then a start there. Leaves a little bit of an imbalance in the market. And that's what a fair value gap is. It's as simple as that. Trading fair value gaps is not something that I do. I do not trade fair value gaps. You can if you want to. But I just thought I'd explain to you what a fair value gap is. Now I want you to go and listen to the strategy that makes you money in the markets. Now, as I said to you 100 times, these price action systems, these gaps in the market, supply and demand, trend resist, trend lines, support and resistance, all these different systems that I show you and all these systems that we trade with are effectively just high probability trades. When we look at squiggly lines in the market, all we're doing is looking at a high probability trade. In other words, I'm going to take a trade with a high probability that it's going to go in my favor. How long is it going to go in my favor? Am I going to make a profit? Am I going to make a loss? Well, that's when you've got to get down to the strategy, because a high probability trade is not going to make you a profitable trader. What it's going to do is give you high probability trades to take. Once you've got those high probability trades, it's up to you and your psychology and your strategy to make money out of it, because too many traders out there go into the market with no strategy. I did a survey recently and most of the guys said it's because I've got no strategy that I'm struggling. And that's a fact. Most people get into the market and they just start trading because somebody or some course, some expensive course told them that the squiggly lines are going to make them money, that the market's somehow objective and it's made up of mathematical algorithms. They didn't tell them that the market's made up of traders and human beings in the background. They told them the market's made up of algorithms and that they're going to make money out of this. So now you get into the market and you just trade willy-nilly. You just buy and sell and you don't know how much profit you're making. You don't know how much loss you make. You just see you made a profit here, you made a profit there, and you made a profit there. And then things start to go pear-shaped and you start to go into losses and you start averaging down and you start moving stop losses away, or maybe you don't even have stop losses in the market because somebody told you that pros don't use stop losses. So you think, well, I'm not going to use a stop loss either, because you don't realize that pros can't use stop losses because they trade with too much money, and so on. And it just gets worse for you. If you don't have a strategy and you don't have proper psychology behind your trading, you are not going to become profitable. It's insanely important for you to understand that you need a strategy in the market if you want to make money. That's as simple as it gets. Go and listen to my strategy. Go and apply the strategy. I put it in every single video, so you can go and have a look at the last videos as well, and they'll all have my strategy in there for you. I'm going to talk to you about that straight after these charts. Go and check it out. So now you know how a fair value gap works, and if you want to use it in your trading, you can. There's nothing wrong with it. Totally up to you. But from my perspective, a fair value gap, you can't really just use a fair value gap for trading. But when you see it there, you can understand that there might be a gap and there might be some money lying in that area. You can use it, but like supply and demand or something to that effect, because that's what a fair value gap is there for. Other than that, not for me. But how do you make the money in the markets? Because as I've told you, you can't make money in the markets with a high probability system. A win rate doesn't make you money. You can have a win rate and you can win 10 trades in a row. You can win 8 out of 10 trades, and that gives you an 80% win rate. You're going to run around boasting that you've got a 80% win rate, and I'm actually quite happy for you. That's great. But what you have to realize is on those 8 trades that you won, especially if you're a scalper, I mean, scalpers usually have a very high win rate. Thing is, you win $10 on each of the 8 trades, which gives you an $80 win. And on the 2 that you lose $1,000 on each one. So you've lost $2,000 and won $80. That doesn't sound like much of a win to me. In fact, sounds a bit like you're losing. Doesn't sound good at all when you think about it. That's the problem with relying on a win rate, because win rates are only viable if they're used to the proper strategy. In other words, if you're winning a lot of trades and you're using the right risk strategy and your trades are hitting take profit, which is 2 to 1 or decent way away, then your win rate might be worth something to you. But in general, people don't trade that way. Most people, what they do, they get into a win, FOMO takes over, and they jump out of the trade almost immediately. I put a little question out the other day as to what makes you fail most of your trading. And do you know that most of you said strategy? Because you don't have a decent strategy. And this is true. So that's why I'm going to tell you what strategy I use to trade and how it makes me a profitable trader. And you can use this strategy and it'll help your psychology, because trading is more subjective than you would believe. Everybody thinks it's objective and the markets are fractal and they're maths and they're this, but they're not. Behind every squiggly line, behind every move in the market, behind every buy and sell, there's a real trader. Someone who wants to buy and sell a share, a Forex trade, a commodity, or something of that nature. Not an algorithm, not a robot, a real human being. Even though there are bots and robots in the market which are trading, do you know what? Behind that bot is a real human being who wants to make money. That's why he's using it. So it's programmed by a human being to his satisfaction and the way he wants it to make money. Imagine if the market was only made up of robots, nothing else, artificial intelligence, and it was just trading. I get the feeling that if they all had the same capability, the market would simply end up on a big zero. How are you going to make money? If everybody's got the same capability of making money, if everybody's got the same system, everybody's got the same strategy, and everybody's got the same mentality, no one's going to make money, because the market's just going to flatline with the buys and sells. Because human beings buy and sell, and we're buying and selling from each other. And there's a willing buyer who feels that this is a good purchase, and there's a willing seller who feels that this is a good sell. And you're both thinking of the same product at the same price at the same time. You have to ask yourself the amazing question: why does he want to sell and why do I want to buy? There's a clear reason. You've both got opposing views. Because believe me, if the guy selling thought that the price was going to go to the moon, he wouldn't sell. And if the guy buying thought that the thing was going to crash out, he wouldn't buy it. So you've both got opposing views. Get this into your head, guys. It's really important. Hope you're getting it, and I hope you're understanding this. But the strategy is simple. The strategy is this. If you have a $100,000 account, and believe me, guys, I've had people say to me, but how do you get $100,000? Guys, I'm using $100,000 as a round figure. Doesn't mean that you can have a $100,000 account. Maybe you've got $1 million account. Maybe you've got a $10,000 account. Doesn't matter. $100,000 account is just a round figure that I'm using so that you can understand the system. The strategy. There's a difference between system and strategy. System gives you high probability trade. The strategy makes you money. Now, with that $100,000 account, you must decide for yourself, how much risk do I want to take per trade? Now, from my side, I prefer to risk 1% per trade on that account. So that 1% of $100,000 is $1,000 risk per trade. So every single trade you take, you risk $1,000. But here's the trick in the strategy, and that is you've determined your risk, and that's all good. That's great. But what you have to do is keep the same risk across the board on every single trade, no matter how you feel about each individual trade. Because there'll be trades that you get and you'll say, this is a no-brainer, I've got to take this trade. and I really need to throw the kitchen sink at it. And you'll get other trades where you'll think, should I or shouldn't I? The problem you've got is the one that you think, should I or shouldn't I, you're only going to put like a small risk on. And the other one, you're going to want to throw a kitchen sink at it and put major risk on it. And guess which one's going to lose? Clearly, the one you threw the kitchen sink at, that's the one that always loses. It's just the way of the markets, guys. That's how it goes. What you've got to do is keep the risk the same across all the trades. Now, why is this? And this is simple. If I was to flip a coin 10 times, it'll probably land on tails 5 times. It will land on heads 5 times. In other words, if you chose heads, you would lose 5 and you would win 5. That's the high probability, no matter what you say. That's the high probability. What you want to do is lose less on the losses and win more on the wins. So in other words, for every win that you get on that coin toss, you want to win 2 coins, and for every loss that you get, you want to lose the 1 coin. That'll give you an overall profit. Now the same goes for trading. Now too many guys make this too objective. They say it has to be exactly 2 to 1 or exactly this or exactly that and take profit at that. No, that's not how the strategy works. What you do, you work out your stop loss. Your stop loss is $1,000. Now how do you put that stop loss into action? All you got to do is go to the charts and say, that's the trade I want to take. You choose your trade. Once you've chosen your trade and you say, that's the trade for me, then you look at that and say, how much is $1,000 down to my stop loss? Because I want to put my stop loss down there. And the stop loss area has got to be an invalidation area. In other words, an area where if you looked at the price, you would say, I wouldn't trade that. That's your stop loss. Now you work out from that area back to the cost, how much is $1,000? Now you know the size of your trade. Now you've got the size of your trade worked out. How many contracts, how many points, how many pips, whatever the case. Now all you got to do is say to yourself, is the risk to reward worth it on this trade? Will I make more than $1,000 on this trade? Is it worth it? Should I take this trade? Because there's no point in taking a trade where you're risking $1,000 and you can only make $100 or $200. What's the point of that? You want to at least make more than $1,000. Preferably $2,000. That's your ultimate. Look at the risk to reward and say, is it possible for me to make a decent profit? Yes. Okay. We can take this trade. We can put our profit in place. We can put our stop loss in place. Now we're in the trade. We know we can make money on this trade. But now the question is, how do we manage this trade? Really simple, guys. When it goes into a loss, you do not dollar cost average. When it gets to your stop loss, don't move your stop loss away. Why would you? Because what did we just say? We just chose that spot with a stop loss as a invalidation area. We just said that area, if the price gets there, this trade is completely invalid. So do not move the stop loss. Take the loss. Learn to take the loss. Like I just said to you, out of 10 coin flips, you're going to lose 5. You're going to win 5 in all high probability. Now you've learned how to lose. That's great. But let's say the trade goes into a win. It starts winning and you're $250, $300 in profit. 99% of you are going to try and take that profit. And which is, by the way, 99% of traders do lose money on 5-minute trading, just in case you didn't know. And 70% of traders do lose money on swing and position trading with geared trading. Do be aware of that, guys. But anyway, that aside. So now the trade is $300 in profit and you want to get out because most of you will be wanting to click that button, get out of that trade as quickly as you possibly can because you're in a profit. I know how your mentality is thinking. It's almost like you've suddenly become a scalper, even though you're a swing trader. The trick here is to sit on your hands and let the trade run. Let the trade get up to $500, $600, $700 in profit. Then take your stop loss, move it up to break even. Now the trade is free. You had a cost of $1,000 on that trade if it went wrong. Now you've got a cost of 0 if it goes wrong. If it comes back and takes out your stop loss, accept it. So be it. You walk away with nothing. You lose nothing. If it goes up into profit, don't click the button when it gets to $2,000. When it gets to $2,000, move your stop loss right up behind it. And if it comes back and it takes out your stop loss, bully for you. You've still made your profit. You pretty much made target. But if it goes through that $2,000 and keeps on going, you make all the money behind that wasn't yours in the first place. That's the great thing about that particular strategy. Now use that strategy and that'll help you to get along in the markets. Now the idea is to add to your trades actually. What I would like is for a particularly a person starting out that hasn't become a profitable trader yet, you need to first learn to follow your trades. You need to first learn to go with your trades and make the full profits. You'll have a whole mishmash of where the stop loss has been taken out in profit and you get small profits, and you'll have a few big losses. And it's quite a difficult run to get to the point where you make that big trade and you make that profit. But out of 10 trades, you really only need 2 winning trades to take you over the profit line. You don't need a whole lot of winning trades. If you get a whole lot of winning trades, you're in the pound seats with this system. You'll make a lot of money. So guys, that's the strategy. Don't forget to watch my last videos on strategy, psychology, systems, how to trade price action. They'll help you in the markets and they'll help you get forward. Don't forget, trading's risky. And don't forget, there's a free Forex book for you down in the link below. Go and grab it. Join as a member and get the trade of the day every day. You might enjoy it. Thanks for watching, guys. Don't forget to sub, and I'll see you next time. I'll see you soon. Don't forget to come back for the live shows. The live shows are fun. We join together and we trade together and we choose the trades as the A team. See you next time. Cheers, ciao, and bye.